All right, fella. So let's just take a look at Meta. Now, I want to focus on their income statement in specifics. So, Meta is obviously falling like crazy right now, but here's the question that I want to answer. What does Meta look like if they decided to cut their Reality Labs segment? So that's the question that we're going to ask. And I'm going to walk through the income statement with you. I'm going to show you all of these different calculations and just kind of the things that you're really looking at when you're going through the income statement. So hopefully you guys are following along and, just pause as needed. So we're going to go on Meta Investor Relations page. We're going to click on this financials. We're going to hover over and click this quarterly earnings. Now we're focusing on Q3 2022. So let's go ahead, download this income statement. We're going to save it, and then we're going to go ahead and open that. We're going to enable editing. All right. So they give us many quarters of data. Let's just count. That's 1, 2, 3, 4, 5, 6, 7, 8. Move over a little bit. That's 9. But maybe 9 quarters of data is too much to work with. So obviously, I want to compare September to September of 2021 to 2022. So let's just hide everything before that. So here's the cells that I'm going to hide. I'm going to hide column C, E, G, I, and those are the 4 I want to hide. So we're going to right click, click hide. Now this is the information that we're dealing with. So let's just go ahead and let's look at the revenue. So keep in mind everything here is in millions. So that essentially means that this is 29 billion right here. So we're essentially comparing this number right here. I'm going to go ahead and highlight that. And actually, I'm going to make this a little bit bigger so you guys can see a little more clear. So we're highlighting this number and we're highlighting this number. Now, when companies are doing their year-over-year comparison, I'm going to show you how they do that. So here in column T, we're going to type in year over year. Now, just so you guys know, I have one hand holding the mic and the other is doing all of this typing and moving with the mouse. So, it's a little bit, it's going to go a little bit slow here, but that's fine because you guys can follow along. So here's what we're going to do. We're going to type the equal sign. We're going to do parentheses. Now, when we're doing year over year percentages, we want to take the year that we're comparing, which is this one right here. And then here's our base year. We're comparing that to 2021. So we're actually going to subtract. Oops. And then we're going to close that parenthesis and we're going to divide it by the base year, which is 2021. So the year that we're in minus the year that we're comparing to, the base year, divided by the base year. So let's go ahead and press enter. And then we're going to put this in percentage form. We're going to carry it over 2 decimal places. So here's what this is saying. It's saying in this quarter, revenue declined about 4.5% from September 30th of 2021. Now, does that make sense? You always got to ask yourself, does this make sense? Well, yes, because this number is bigger than this number. Does it look like it's about 4.5%? Yeah, I'd say so. So always do that mental check right there, because sometimes you can mess up the numbers. And now we're going to look at cost and expense. So they break it down into cost of revenue, R&D, marketing and sales, general and administrative, and then they give us the total cost and expense. Now we could create this new line item. Let's call it cost as a percentage to revenue. So cost as percentage to revenue. There we go. So this is what we're going to do. We're going to do the equal parentheses. Now we're going to get our cost, our total cost right here. We're going to divide that by the revenue number. Close those parentheses and click enter. And then we're going to do this as a percentage. Or we could do it in a monetary form. So maybe monetary form will actually help you guys understand this a bit. And then I'm going to go ahead, drag this formula all the way over. So this is what this is saying. For every $1 of revenue, 64 cents is going towards these costs right here. So now you guys can see that this cost is creeping up. So here in 2021, 63 cents was 63 cents out of every dollar was going towards these costs. Here in March of 2022, it's 69 cents, 71. Now we have a whopping 80 cents for every single dollar of revenue going towards these costs. So, that's pretty nasty increase right there. So obviously, the income is going to be less. So here, we're looking at 10.423 billion. Here, we're looking at 5.664 billion. Now, not only did we have revenue decline, we had the cost increase. So let's go ahead and highlight this as well. So now we can actually go ahead and do a comparison. So we're going to do the similar method right here. We're going to get the current that we're comparing minus the base, and then we're going to divide by the base. Oops. There we go. All right, so as you guys can see, that is a 45.66% decrease in income from operations. That's pretty big. I mean, you guys can see it right here. That's 10.423 billion compared to 5.664 billion. I mean, clearly there's something going on here. So now we're going to scroll down a little bit more. We have this interest and other income expense, and then we have income before income taxes, and net income. So here's something else we could do. Let's just go ahead and calculate the income tax percentage. What are we paying to the government? So here's how you do that. We're going to do equal. We're going to get the amount that we're paying to the government, and then we're going to divide that by the income before income tax. And then we're going to put this in percentage form right here. Carry that over 2 decimal places. Now we are paying 21.18% in income taxes. And we're going to use this a little bit later. So that's the reason why we calculated that. So let's go ahead, highlight that. So now we're going to scroll down a little bit more, and we could see basic and diluted earnings per share. So here we can see that in the September 2021 quarter, we made $3.22 in diluted earnings per share. Now I'm using diluted because that is a little bit more conservative because we're taking into consideration future dilution. So that's why I'm using diluted. And then here in the most recent quarter, we got $1.64. So let's just go ahead and let's do a comparison again. So we're going to take the current year, equal. We're going to take the current year, and then we're going to subtract the base year, and then we're going to divide by the base year. Enter, put this in a percentage, and 2 decimal places. That is 49%. So it's just about 50% decline in diluted earnings per share. So that's pretty big, you guys. I mean, it's not a surprise that, we're falling pretty hard after this earnings report. Now let's take a look at the earnings per share numbers. So here, this is in billions. So we have about 2.859 billion shares outstanding. Right here we have 2.687 billion shares outstanding. Now take a look at the trend. This number is going down, as you guys can see. So now let's go ahead and let's do a calculation here. So I'm going to take the current minus the base, And then we're going to divide that by the base. Percentage. So as you guys can see, the amount of shares has declined by about 6%. So, that's pretty good. But keep this in mind, they were buying these shares at pretty high prices. It's much, much lower now. So, from an investor standpoint, it's not really a good thing. Now, if they could turn around their revenues and their income, then yeah, it's a great thing because it shows that they were buying back these shares. And then, if they could bring the share price back above the price that they were buying these shares back at, then yeah, we'll see that as a good thing. But as of now, not really that great. Now, if they do decide to buy a bunch of shares in this $90 region, and then we start shooting up towards like 150, yeah, that's what investors want to see. That's good. Now, let's pay attention to these expenses right here. Now, these expenses are actually related to the stock-based compensation expense. So they're essentially just showing us how this total share-based compensation expense is calculated. As you guys can see, most of this is going towards R&D. So, we're just looking right here, and then we're comparing that to this right here. So as you guys can see, the share-based compensation expense has been increasing. Now, does that make sense? Well, yeah, it does make sense. They have a whole new segment that they're trying to grow, the Reality Labs segment. So let's just go ahead, let's do a calculation right here. How much has this actually increased? So by now, you guys should be pretty familiar with this calculation method. We're taking the current, subtracting it by the base, and then dividing by the base. Now, these expenses went up 31.74%. Now, here we have segment revenue. Now, this is really nice information right here because now we can see how their revenue is broken down. So, they have their advertising, they have their other revenue, family of apps, Reality Labs, and total revenue. Now, let's just take a look at their family of apps. So, as you guys can see, it has declined just a little bit. So, let's just calculate what that is. By the way, this is where a lot of their revenues are coming from, as well as advertising. So we're going to take the current minus the base, and then we're going to divide that by the base. As you guys can see, that is a 3.6% decline. Now, let's just go ahead and look at their Reality Labs right here. By the way, I do want to make this clear that this family of apps revenue is essentially these two combined. So this little line right here is basically telling us that they're doing a subtotal. So advertising plus other revenue is equal to family of apps revenue right here. Just so you guys know. Now we're going to look at Reality Labs. We're comparing this to this right here. And as you guys can see, the trend is pretty weak. We had this one nice number right here. And then, obviously we have 285 million. So if we're comparing this to this, it's gone down pretty significantly. So we're going to do equals. And then we're going to subtract that by the base, divided by the base. Now, you guys, this is not what investors want to see. I mean, they're spending so much money in Reality Labs, and we're getting a revenue decline of almost 50%. Yeah, I mean, investors don't like that. Investors would actually prefer Facebook to just completely cut the segment out so that, our shares can go up. Because right now, Reality Labs is acting as a massive, massive anchor to our earnings potential in Meta. And I'm going to show you that next. So here we have income slash loss from operations. Oh boy, now here's the kicker. I mean, this is what we're looking at. We're looking at a $3.672 billion loss coming from Reality Labs. So yeah, I mean, pretty big loss right there. And if we're just looking at the family of apps, we're reeling in 9.336 billion. So Meta is a very, very profitable company, you guys. I mean, don't let anybody tell you that Meta is going bankrupt. That is so far from the truth. They are bringing in so much money. I mean, they're bringing in $9.336 billion just from their family of apps. And, this Reality Labs, this is an investment. This is money going out. So, if we're looking at their total income from operations, that is $5.664 billion. So now we're going to answer that question. What does Meta look like on their income statement if we decide to take out this Reality Labs? So now we're just going to make this little segment right here. So let's just start with line item income or operating income. Now our operating income is essentially just this family of apps right here, because we're pretending like Reality Labs doesn't exist. Now let's scroll up a little bit. As you guys can see, we have this little line item. It says interest and other income expense net. So we're going to go ahead, we're going to take that. That is cell S19. So we're going to do other expense equals S19. And then now we're going to do income before income tax. Now remember, I'm typing with one hand, so I'm doing all these abbreviations. And then we're going to do a summation. So this is our income before income tax. Now we're going to do tax. And we calculated that tax percentage. So essentially, where is that tax percentage? It's right here. That is cell T21. So we're going to get this number. We're going to multiply it by T21. That is our income tax expense. And then now we are going to do our net income. So net income is just the income before income tax minus the income tax. So that's our net income. We're going to go ahead and get our diluted share count. Let's go ahead, let's find that information again. So that is this cell right here, that is S30. And then now we're going to calculate earnings per share. Now earnings per share calculation is essentially just net income divided by diluted shares. All right, so our earnings per share will be $2.71 approximately. Keep in mind that this is a rough calculation because we're going to have things like diluted shares that are added because of Meta. So that is a little bit harder to separate out. I mean, I don't really know what that exact amount is because of the Metaverse Edition. So keep in mind that this number could actually be slightly off. Now let's go ahead and compare that to what we actually got. So we got $1.64 when if we took out the Reality Labs segment, we could have got $2.71. So that's pretty big. Now let's go ahead and let's calculate the trailing 12 months earnings per share. So we're going to do TTM EPS. Now that is essentially going to consist of the 4 most recent quarters. So we're going to do equals and summation. And we're going to get the 4 most recent quarters of earnings per share. So let's find that. All right, so currently this is the current trailing 12 months earnings per share. It's $10.50. Now this is obviously going to come down because ad spending, it's going down. We are essentially in a ad recession. And on top of that, this Reality Labs segment, it continues to lose a lot of money. So obviously we're going to see this earnings per share figure continue to drop. Now, as you guys can see, our most recent earnings per share was very, very weak. It was $1.64. So, yikes. And we could have been making $2.71. So this is essentially me letting you know what does Meta look like if we decided to take out that Reality Labs segment. So, we could have been making $2.71, but instead we made $1.64 in earnings per share. And, this trailing 12 months earnings per share, it's not necessarily representing a very accurate situation of the future because like I said, ad spending is going down and, the spending on the Reality Labs, that is going up. So, let's just pretend that the next few quarters are going to be just as crappy as this one. So I'm just going to get that $1.64 amount. We're going to multiply it by 4. So yeah, if every quarter was just as crappy as this one, then yeah, it would be something like $6.56 for the earnings per share. Now, if I recall, Meta, I think it was trading around $100. So if we get the share price right now, let's just put the share price right here. Now let's just put the PE right here. So let's just work off the estimate that, the next few quarters are going to be just as crappy as this one. Well then, what's the PE multiple? It would be 1524. And right about now, let's just calculate what our actual PE ratio is right now using the 4 most recent quarters. So, right now people might say, oh, Meta is so cheap right now. It's trading at a PE of $9.53. But, they're not taking into consideration that we could be going into a ad recession and that, we are going to continue to see larger and larger expenses in this Reality Labs sector. So, obviously, something in between this and something in between this and this would probably be within expectation. Like this obviously being the higher amount, this obviously being like the lower amount. And it could be possible that the next 4 quarters of earnings going forward could just get weaker and weaker and weaker, and we could actually go below the $6.56 of earnings per share. So, obviously, if we're going off this lower assumption, price to earnings right now at $100 a share would be 15.24. And price to earnings right now, going off where we currently are, that would be $9.53 or 9.53. So I do want to make this clear. This isn't in dollars. So let's just go ahead and go back to general, because PE is not a dollar amount. So here's one last thing that I want to do. We could go to this website. It's called Macro Trends, and we could type in Meta, and we could go to price ratio. Now, if we go to this price ratio tab, we could type in this PE ratio, or we could click on this tab right here. And then what they're giving us is the PE, a graph of the PE. So now they have this broken down right here. So as you guys can see, they have the date, the stock price, trailing 12 months, net earnings per share, and PE ratio. So, the PE ratio definitely gets frothy right around here. So I could go ahead and decide, this 2016 area best represents the PE multiples. So I'm going to go ahead, copy all of this data, go back to my Excel spreadsheet. We're going to go ahead and paste this, and we're going to keep the source formatting. Going to expand this cell right here. And now what I can do is I could take an average of all of this PE data. So in this cell, I'm going to do equals average. And here we can see in the last few years, Meta has averaged around 26 in PE multiples. And that makes sense because, their revenue was growing in the past. But as you guys can see now, with the most recent quarter of earnings, their revenue is declining. It's looking to be 4.5% decline just from this quarter. So here's the bottom line here. So here's the bottom line. Revenue is declining, and on top of that, expenses are increasing, and you got this segment that's literally just eating away at net profits. And if we were to just take this segment away, they would be much, much more profitable. But, Meta, Mark Zuckerberg, they see this as a long-term investment so that they can eventually significantly grow their revenues. Because as of right now, they're starting to see their company go through maturity. And to them, this is a little bit worrisome. And that's why they're taking this gamble, because it's a gamble. It's definitely a gamble. They're taking this gamble that this Reality Labs segment is going to bring in massive revenue for them, 10 years into the future. But, we don't know that. That's completely mysterious. This segment could just completely flop, and they could be over $10 billion down from this segment alone. So that's a very possible future, but just know that if they ever do decide to cut this segment, then yeah, the stock price would likely go up, because as you guys can see, we are losing a significant amount of money from this sector. Now, I hope you guys enjoyed this analysis, and have a great one.